Hello everyone, and welcome to another closed-end fund mastery video. In this particular video, I'm going to reveal and explain my latest two additions to the CEF Mastery Super Screener and Interactive Report. These two particular changes focus on the interactive portion of the CEF Mastery Super Screener, which is located on the fund stats page. One of the funds that I'm going to use to illustrate my two latest additions will be RMT, Royce Microcap Trust, which I have personally purchased a couple of days ago at $10.08 a share, I believe. It is a managed distribution fund. So in today's current market environment, I would not be surprised if they announce a slight decrease in the distribution at their next declaration. That aside, let's get to the two new features. The first new feature is I have just recently added trend lines to the balance sheet portion of the fund stats page. These trend lines give you a long-term view of a fund's assets and liabilities over a period of time. How will these trend lines help you? For a lot of you, it might be obvious, but for the novice investor, you want to see the relationship between assets and liabilities of a fund over a period of time. Ideally, what you would like to see, as is the case with RMT, a fund's assets increasing at a greater degree than its liabilities, or at the very least, have a fund's assets run parallel with its liabilities. What you do not want to see is a fund's liabilities increasing faster than the rate of its assets, or even worse, have a fund whose assets are declining while their liabilities are increasing, which could be a clear warning sign that a fund is having to borrow money just to be able to maintain its distribution. Ordinarily, this isn't a bad thing because funds often have to borrow money to make their distributions, but that is often not an issue if the fund is doing so while its assets are increasing faster than its liabilities. We're going to come back to the balance sheet in a couple minutes because I want to show you a couple scenarios you might definitely want to avoid. Before we do that, we're going to move on to the second added feature to the closed-end fund mastery super screener and interactive report, which I think will have a much more significant contribution to the program, and that is the fund score history chart. The fund score history chart records the score, final score, and the estimated number of distributions remaining of a fund on a monthly basis. You can think of the score as the managerial report card for a particular fund and see how well that fund has managed over the long term. These scores are derived from the annual and semi-annual report that comes out every 6 months. So you'll notice that the score changes little over an extended period of time until the next 6-month report comes out. The final score grades a fund's performance since their last semi-annual or annual report. The final score consists of elements such as net asset value performance, premium discount, estimated debt to equity, estimated number of distributions remaining, discount and premium in relation to the percentage increase or decrease in the fund's net asset value, etc. The estimated number of distributions remaining basically divides a fund's accumulated earnings based on an estimated share count and divides it into months to give you an idea of how long a fund can continue to pay its distributions before having to consider reducing their distribution or having to borrow money to pay their distribution. For example, in this particular chart for RMT, you can see as of April the 2nd, 2022, there is an estimated 51 monthly distributions remaining before they would have to consider cutting their distribution or borrowing money to maintain their distribution. Now, granted, this is a nuanced number because funds have available to them several tricks up their sleeve. For example, instead of paying their distributions entirely from accumulated earnings, they could mix it with a portion of return of capital, which would actually increase that 51 number to a much higher number. Now, I debated on whether to use net asset value or the estimated number of distributions remaining. And I ultimately concluded that using the estimated number of distributions remaining provides a much clearer picture of the fund's distribution health than simply using the NAV. For example, using the fund RMT, you go back to January, the fund's net asset value dropped $1.51 a share, or 11.6%. That decrease of $1.51 in net asset value reduced the estimated number of monthly distributions remaining from 86 months to 59 months. Had I used net asset value, while a decrease of 11.6% in net asset value is significant, it doesn't really translate into telling you how much of an impact it has on the fund's ability to pay its distributions. As in this particular case, the $1.51 decrease in net asset value reduced the fund's accumulated earnings to the equivalent of around 27 monthly payments, or 2.25 years. Net asset value doesn't tell you that. It just says the fund is down by a lot, and that's it. I'm about to wrap this video up, but before I do, I'm going to give you a couple more quick examples. For those of you that receive my weekly distribution change updates, you may recall the numerous MLP Energy Funds significantly increasing their distributions. For example, TYG, they just increased their quarterly distribution by 57.78%, 71 cents a quarter. Or CEM just increased their quarterly distribution 22.45% to 60 cents a share. Now, while that increase is significant, the yield ultimately only winds up to about 6.67% for CEM and only 8.18% for TYG. The reason these funds have been able to make these significant increases in their distributions is because their estimated number of distributions remaining have increased substantially over the past 3 months, going from a negative 164 to a negative 81 for TYG, and from a negative 94 to a negative 35 for CEM. And while the increase is rather significant and impressive, ultimately they are still running on negative accumulated earnings. And this huge increase in earnings has had a significant effect on their final score as well. But as impressive as that is, if we move on up to the balance sheet chart with our new trend lines added, TYG, you can see that their liabilities are going down, but their assets are going down at an even sharper decline. The same goes for CEM, decreasing liabilities, which is a good thing, but even faster decreasing assets. And as I point out in my weekly distribution updates, while everything is fine, while the price of oil continues to go up, it could be devastating when the wells dry up. And in my humble opinion, a yield of 6.67% isn't worth the risk. But that's just me. Anyway, that's it for the feature update video. If you currently aren't a subscriber to the YouTube channel, click the subscribe button and the thumbs up. I'll be putting out more videos in the future. If you aren't a subscriber to CEF Mastery Super Screener and Interactive Report, all the links are below with information on how to get your free report. Thanks again for watching.